So we're talking about Helicopter Ben here. He's coming through. He's saving the markets. Markets rallying across the board. JSE sitting at a record high. But I suppose when he comes through with quantitative easing 3, it means that all is certainly not well in the United States.
You know, I've studied economics for many years, and I just haven't seen this in the textbooks. So I don't know what's going to happen here. But my suspicion is that you cannot print wealth. And this thing is going to blow up somewhere. I think we're creating bubbles, and the most obvious bubble is on the bond market. There is a huge bubble on the bond market. You cannot keep on just pumping up the markets with hot air, and that is essentially what is happening. And the unfortunate part is that the markets, and we saw the JSE in a record high today again. The JSE is in a record high not because of local economic performance or economic performance,
well, certainly
but
not
because of policy
because
changes.
You see the mining sector rallying today, you know, being bought by foreigners, certainly not because of local factors.
So that is wrong. So something is fundamentally wrong. My suspicion is that the outcome of all this must be inflation. It has to be inflation. But we've said this for the past year, in fact longer, that eventually we will see the US dollar starting losing some of its value, and the dollar just keeps on bumping back or jumping back. And well, what we've seen it recently, the last couple of days, gold price going up and all that. This can't last.
Okay,
it's
so
not sustainable.
It's very worrying, and then you worry how it's going to affect bond inflows into the local market. But we've got MPC next week, so let's throw all this economic data that we've had in South Africa this week forward to next week, and how it's going to impact the MPC decision.
All right, let's just have a look at the current account deficit, which I think is very important. A deficit of 6.5% roughly to GDP is just totally unsustainable. That means that we have to export stuff to fund our imports. Remember, 6.5%, 6.4% relative to GDP means that we consume 6.4% more than what we produce. So you don't need any stimulus to the consumption side, to the demand side in the economy. On top of that, you have to fund these inflows. So you have to pay somehow for the PlayStations and the DVDs and the flat screen TVs that we are importing. The most important export product for South Africa is platinum. So we just closed down our platinum production sites. So we don't have the platinum to export anymore. That tells me that if we don't get the capital inflows, the rand must take a bit of a knock. Now we've seen the dollar coming under pressure today, and the rand gaining a little bit against the dollar, not that much. So I think we are fortunate in that South Africa was included in this bond index recently. That led to an inflow of capital in South Africa. But if it hasn't been for that, I'm afraid the rand could have been much worse. With that background, looking at what the Reserve Bank is going to do, why would you want to cut rates? Because demand is not a problem. We've got sufficient demand in the economy. Inflation is not really a problem. It may come down a little bit, but over time it's probably going to go up a little bit. Demand for credit is there. I can't think of any reason why we should cut rates. In fact, I can think of many reasons why we should be increasing interest rates. I don't think the Reserve Bank should. I'm just saying that I guess the arguments are more in favor of a rate increase. So my guess is that the Reserve Bank is going to leave interest rates unchanged. In fact, the last cut by the Reserve Bank came as a surprise to me. I don't think anything happened. I don't think it added anything to economic performance in South Africa. And in fact, I think things deteriorated. And I think the current account deficit is perhaps a sign of that.
Yeah, and they did say they were taking out a bit of insurance for the future. Dawie, thank you very much for joining us today. Dawie Roodt, a senior economist at the Efficient Group.